Would you agree with Jim? I mean, you think the Fed just needs to maybe not do it all, but don't raise 25 basis points, 0.5% at every meeting the rest of the year. What would you do if you were in charge of the Fed?
Well, I think they're on a decent path right now. I think 50 at a time has sent a pretty clear message. You've seen the 10-year rise very quickly. You've seen financial conditions tighten pretty well, and they've made some pretty good guidance in terms of reducing the balance sheet. You could certainly go for that bigger shock factor, although I think that would just more shock the markets rather than shock inflation. So I think they have to keep after the game plan and look for inflation to start to fade in coming months.
By the way, I love your tie. I'm not sure if we emailed yesterday inadvertently without me remembering.
Coordination Friday.
Anyway, Robert, if you can't, it is Coordination Friday, unlike the Fed, I guess. Robert, I think the point, though, is that, and listen, I'm not going to knock my own network, but we talk about the Fed so much. Who said this? They said that. Tomorrow they say this, but yesterday they said that. And you just wonder, it's this constant sort of source of not only almost market anxiety. Because did they waver? Are they getting more? Did they get more? What did Mester say? And I just wonder if it's not better to take the pain now to sort of clean out the excess froth in this markets. By the way, if we haven't done that already.
Right. That's right. I think that's a good point. And then I think the question is, whether that shock value treatment will work in terms of curing inflation. And I think part of the problem is that some of these inflationary problems are, of course, Fed and policy related, and some of them are not. And so whether they get solved quickly enough to take some of the burden off of investors remains an open question. I think my fear with inflation here, and the reason I think investors are so challenged by it, is that it has removed any policy flexibility from the Fed. And so until inflation goes away, whether they raise rates a lot or a little, they have no flexibility. And so every event that comes up is treated as an amplified risk rather than sort of a normal risk. And I think that's the scare we see going on here with the slowdown in economic growth.
Yeah, and either the market is predicting a massive slowdown ahead, it's wrong, or this is just a reaction to what has been and let's not lose historical context. The S&P 500 and NASDAQ, and they've doubled from the pandemic low, so it's been a heck of a good run. What are you telling your clients right now? I'm sure they're nervous, maybe a little bit afraid, probably ready to hit the sell button. What's your best piece of advice right now?
So our best piece of advice is to extend your time horizon. So sentiment has become terrible. Almost every sentiment metric is at maximum negative. Valuations have come in a bit. They're now sitting around the 10-year average. So we think that provides a little bit of a compelling backdrop for investors with a longer term time horizon. And you have to be patient against this constant slew of, as you say, every piece of news is very heavily scrutinized. And I think because you don't have the policy flexibility, each piece of news is treated in a very negative light in the current environment. So until we get inflation under control a little bit more, it will continue to be choppy. But when we look out to the other side, we think companies will still do a pretty good job posting earnings.